Wei Yu is the Director of Industry Solutions here at MongoDB. Ashwin is a Senior Solutions Architect in Solutions Consulting. And now they're going to be talking about supercharging credit application with generative AI. Thank you guys for joining, and take it away.
Thank you. So, good afternoon, everyone. I think we are being introduced, so I will not say more about myself. Today, we are going to talk about credit application with generative AI. Maybe let me first explain what is credit application. So, if you go to a bank, if you apply a loan, to me, that's a credit application. If you apply for a credit card, that is also a credit application, right? So as long as you apply to use a product that gives you some form of credit financing, that is, that's a credit application, right? So, and one of the key components when you apply for some form of credit, behind the scene, be it the bank or some form of financial institutions that provide you with the credit, would almost always do one thing. I'm not sure if the audience, you could guess what is that one thing that they will do to assess your risk, which is to perform a credit scoring, right? And depending on country, so they may use, like in US, they may use your credit score, I don't know, be it FICO or Vantage score, but in other countries, they have different form of scoring. And the institution themselves may perform their own scoring, not necessarily using so-called externally provided scoring. And credit score can impact your life a lot, right? It can impact whether you get this loan or credit card. It can maybe even impact the premium of your insurance. Or I was told in US, when you try to rent or lease a place, the landlord may even check your credit score to decide whether to give you a room to stay. Right, so credit scoring is an important part of, I think, of many people's life in many different countries. But one of the issues with credit scoring is that it can be fairly complex, and it also has many challenges that come with it that I'm going to describe further. So today I'm going to, together with my colleague Ashwin, we're going to describe to you a few key elements of credit scoring. So first, we're going to introduce to you the concept of traditional credit scoring, okay? And then we're going to talk about alternative credit scoring. And lastly, we're going to describe to you how AI and generative AI together will make the whole credit application better for the applicants and also better for the financial institutions, okay? And this will be also followed by a demo. So first, let's talk about traditional credit scoring. Traditionally, in the very old days, when someone is giving out a loan, they would use a lot of expert judgment. Or even your friend coming to you to get a loan, to borrow some money from you, you probably will use your own expert judgment to decide whether this person is credit worthy to give out that amount of money. Of course, as an institution, you cannot always just do the expert judgment for every single loan. You probably have to also combine with something called the statistical technique to quantify the risk. And depending on the type of loan, maybe for retail loan, you could do this because of the mass that you're dealing with. You couldn't, I mean, MASS, not MESS. You have to apply some automation of the risk quantification to assess the risk of everyone. But in some more complex loans or credit applications, you may need to blend both statistical techniques and also human expert judgment, right? And more details you can find in my slide, the reference from the World Bank. And to give a more concrete description what a traditional, so everything is relative. So what I'm describing here is based on what a lot of literature, including the World Bank, have mentioned. Traditional credit scoring typically are simple. They use a few factors to try to describe the credit profile of a borrower or applicant. So in this case, I use a combination of some of the popular credit scoring model in US. It's not A or B. I kind of combine some of the elements of a few vendors so that they don't see me as trying to blame them for using a traditional model, because it's not from any one of them. It's a combination of a few. So you look at the traditional credit scoring. First, they use a few factors. There are altogether 5 factors here. So one is to look at your repayment history. Second is to basically how well you repay on certain loans. How much you use your credit. So if you're given a credit line, how much do you use this credit line? Credit history. How long have you been borrowing monies or asking for credit from the financial institution? And how much new loans or new credit you're asking from the institution? And how much you are owing the institution still, right? So these are some of the common factors that are used. And in a typical traditional scoring, you use some form of linear regression, like probably you learned in your statistics or in school, and you get your points and you all these factors, and you try to do a linear regression to derive the weights. Okay, and that's simply how it's done. So based on 5 factors, the institution is going to decide whether you're a credible person or not. Okay, that's how it is. Can you even decide the character of a person by using 10 features of that person? Probably very hard, right? And it's not to mention, so you see some description that I have at the bottom, model issue. I'm not even talking about application to credit. The issue of using this simplistic linear regression has technically a few issues. So first, it's very simplistic. So how do you properly describe any form of risk? By just using 5 factors, okay? And then here we assume something. We are doing a linear regression, right? So we assume that all the factors have linear impact. So I increased by 1%. This has a 1% impact. But is this true? Second, multi-collinearity, meaning that in the linear regression model, we assume the factors have no correlation between them. But is this true? Right? If, say, you are not repaying properly, what do you think this person will do? Well, most likely he will draw on more credit because it doesn't have money to pay off. So it keeps drawing the credit. So is it really not related, not correlated? And also the data set completeness, because if you ask for credit history, a student that just graduated from university, or maybe even worse, he's going to a university, he wants some loan, and he has not gone to a bank. So where is the credit history to be provided? Okay, so you see, technically there's some issue, right? So if we apply this to credit application, so as mentioned, one of the issues is, yeah, I have no or limited credit history, especially these days. We have a lot of young people already start working, and YouTubers who actually make millions of dollars, you know, kids who make millions of dollars, but they have no credit history, right? Second, credit utilization. If I give you 10,000 credit line, should you use or should you not use? If you use a lot, oh, it's bad because you don't have enough money, so you want to use. But if you don't use, the bank may keep calling you, hey, we have the credit line, why are you not using? Because when you use, there's a chance that they can make more money. So, to use or not to use. Third, the impact of income. So although income was not actually in the formula, but the income is indirectly incorporated, because most of the banks, for example, they have something called the debt to income ratio. So beside the formula, they still do some other check. Like a typical formula that most countries would use would be debt to income ratio. So income will still have an impact. But income today, in this so-called gig economy, everybody is sidelining, be it a YouTube or maybe a food rider or something. They not necessarily have the salary slip and so on. For this, for example, the $1 million YouTuber. So how do you decide the debt to income ratio, right? And last but not least, for example, with the COVID crisis, a lot of the behavior of salary workers or even the whole market has changed. Like just I mentioned the gig economy. It has risen over the years, but I think with COVID, the explosion of this, a lot of the business are done online. Not necessarily they would take a salary job. They may do some e-commerce business that they may not have a salary slip to provide you, okay, to even get that financial statement or the financial information that's needed often in the traditional scoring. Okay, so you see from the description just now, both the model itself, the simplistic of the linear regression model, and the application to credit, both brings a lot of challenges. And what this often means, this means that a lot of people who needed the credit actually could not get this. So that's why you heard a lot about, oh, actually institutions like banks are biased against people. They don't give the underbanked or unbanked people the chance to get credit and make their life worse, right? So if we look at some statistics, so statistics like, for example, the Journal of Financial Economics actually find that the minority group, okay, which often maybe they don't have a proper job, or maybe due to even the location where they stay, etc., etc., they were often found to be charged a higher interest rate. Why? Because they don't have all the information that I mentioned just now, the income, the credit history, and so on. So in order for the bank to provide the loan, they have to compensate their risk. They have to increase the interest rate charge to compensate the risk. Okay, so that's the reason why. And also there's a 14% higher chance that this group of people are rejected. So the bank may feel that they are so risky because I don't have, let's say, 3 out of the 5 factors that I need for my scoring. So I don't even want to take the risk. I will just reject, okay? So it's bad for the applicant, but it could also be bad for the banks because they could have a chance to make the money from giving out the loan, but they just rejected that. Although you could say that, oh, it could be very risky, but the issue is how you assess your risk. Your risk is being assessed based on 5 factors, okay? So over the years, new mechanisms have come out. And actually a lot of them has been applied by the many fintechs out there, which is called the alternative credit scoring, which is essentially to use alternative data, unlike the traditional data that I mentioned, like the 5 elements of data, to assess the credit profile. And when I say alternative data, I don't just mean when I say alternative credit scoring, I don't just mean you use only the alternative data, but you often combine with the traditional data to give it a more complete profile. And I'll describe to you a bit more the details of alternative credit scoring. But let's quickly look at what, for example, McKinsey has mentioned about using the smarter alternative credit scoring. So from the survey, they found that the financial institutions using alternative credit scoring could actually improve their revenue up by 15%. And also at the same time to reduce their credit losses by up to 40%. And also very importantly, that is almost for sure, is that by using this smarter alternative credit scoring, they have also improved their efficiency of giving out a loan by up to 40%. And part of this efficiency gain is not just about using alternative data, but also using a smarter mechanism, which is machine learning. Since today we talk a lot about AI, I think we have to at a minimum mention machine learning. Okay, it's not like Gen AI whereby actually go a bit further, you use deep learning within the machine learning, right? But by using machine learning, which is what the next slide I'm going to come to describe to you. So if I'm going to summarize what is alternative credit scoring, I would say there are 2 key elements. One, the use of alternative data, which I'm going to describe to you a bit more what are examples of alternative data. And also the use of newer quantification technique like using machine learning instead of the simple linear regression. The combination of these two would help you to improve your credit scoring mechanism, and I'll just simply also describe this as the alternative credit scoring. And on this screenshot, you can see the reference is from HKMA, the Hong Kong Monetary Authority. They have recently, the last few years, they've commissioned a white paper to study and to encourage the banks to apply alternative credit scoring to small media enterprises or small media enterprises. Because for the credit score that we've seen just now, most of the time it's applied to borrower individuals, but another group of people who are often missed out in their credit scoring, they are the so-called biased group of people, are the micro SME. Like you may be running a consulting business yourself or with your spouse, and you are a two-person company, you are typically considered as a micro SME, okay? Or even small company of 10, 20 people, they are still small SME. And a lot of them suffer the same issue. They do not have that type of information that financial institutions or banks wanted from them. So seeing this a problem, okay, especially in Asia, like working in China, Indonesia, and so on, India, there's a lot of this micro SME that power the economy, right? And how do we address this group of people who are not getting the necessary financing to build their business for their country or for themselves? So HKMA actually initiated the initiative to program to make better use of alternative credit scoring, but also to deal with one very important thing, which is to have that alternative data. So they actually also have set up a initiative to collect the data to help the banks to better profile their customers. So if you look at this screenshot, which is extracted from the HKMA paper, so step 1, collect your alternative data sources. Step 2, apply adaptive credit scoring, which essentially is about using machine learning, because we know machine learning can adapt and learn from the new parameters that are appearing in your credit profile customers. And then after you have the score, you can make the decision either automatically, or if it's a more complex loan with a bigger company, you can involve human and so on, right? And lastly, of course, this would, once approved or rejected, the applicant would actually receive the necessary notification. But there is also often a problem with the notification given to a borrower. So let's say you apply for a credit card. I believe all you are very lucky, right? You never get rejected for a credit card. Actually, my friend here recently just got rejected. And serious, he can tell you the story later, okay? And do you know what happens when you get rejected? Does the bank actually explain to you always why you are rejected in more detail, not just saying, you have a poor credit profile, rejection code 123, or it actually help you, explain to you and tell you how you can do better? You think about it. I think most of the time they don't, all right? And of course, if they reject you, would they also recommend something to help you? Like let's say the young man here maybe are going to get married soon, and maybe you need some loan for organizing a 1,000 people wedding, and you need some money, but because of your poor credit profile, they don't give you the loan, but they don't offer you alternative suggestion and leave you there in cold. That shouldn't be the case, right? So how we can help with this process? So, but let's come back to this point about alternative data. So these are some examples of alternative data that we could maybe easily produce. Like utility bills, almost every one of you must have utility bills, right? So this could be additional alternative data, which actually is not new. I worked with telcos 10, 15 years ago, and they already start using utility bills to decide whether they want to give you a mobile phone loan, all right? So rental bills, as mentioned. I think a lot of people may own a house, which is great. That could be evidence that you are somewhat well off, or you could be renting, and the rental bill could be also an alternative data. And these days, almost for sure, even if you don't have utility bills, you always use your neighbor's water, and you never rent, you always sleep at your friend's place, you would have a mobile phone, right? If there's someone here with no mobile phone, you can walk away from here, that's fine. So there's a lot of mobile information, your mobile shopping, your whatever in-app, even your chats and so on. They could provide additional information about, of course, at the consent of the borrower to collect the information, and there's various mechanisms to protect the privacy, which I could describe to you off stage. But all this, including your shopping behavior, I think every one of you here must have done some online shopping, and all this information could be collected either directly with the consent of the borrower or through third-party data aggregator and so on. So these are just a short list of a long list of alternative data that are useful in understanding a credit profile. And you can of course look at the HKMA paper, they describe a longer list, and there are many other lists that you can look at. So now, how can we help with generative AI? Just now I mentioned, we can use machine learning combined with alternative data to improve the credit scoring. But how would generative AI come in help? So there are a few key things. What is the strength of generative AI? Okay, we heard a lot today, but what really is the strength? One, abstract data. So it can give you a summary. You must have used ChatGPT and asked it to tell you how to write your working report to your manager for the next day or the next minute. It can actually also do some advice. So for example, if you chuck in my poorly written report and ask him where I can adjust, you can look at ChatGPT. It can actually tell you this is the place where you can revise and what is wrong with it. If you have never tried that, you should have this conversation with ChatGPT, for example. It can give you some advice on the text, and pretty good. Actually, a lot of times you write a better text, and it can even tell me where it's written poorly and what's the reason that they feel is written poorly. So don't forget the advice part. And then what it can also do is that it can quickly adapt. You give it new information very quickly, you take the new information and then give you the appropriate summarization advice according to new information. And last but not least, although we are always using ChatGPT as thinking that that's the only mode it can be used, no. All these LLM models, they can be called by APIs. And often these APIs are in JSON. That's why it makes full sense to run on a JSON-based database, which is MongoDB, I heard. Yeah. Okay. So these are some of the key characteristics of how generative AI could help. But what is in this context of credit application? So I will leave you to see the details with Ashwin, but I just want to say quickly a few things to summarize this section. One, we could use AI, and more specifically machine learning, with alternative data. And alternative data often come in different forms, structured and often unstructured, which makes JSON a great choice. And of course, MongoDB an even better choice. Second, you can use generative AI in addition to ML to do what? To advise when you reject the application. You can use GenAI to explain why you reject. What are the areas it can be improved? So that someone who gets a rejection can do something to get a better credit. And third, it can also recommend you an alternative solution to what you're asking. Although you don't qualify for this, premium cards, but maybe you can go for basic cards, and these are the reasons why. So these are some of the examples, and whole process could be automated, right? So these are some ideas, and we can look at it later. So you have seen this slide in the morning from our keynote speaker. I'm not going to go into detail, but one key thing in this whole process is about credit scoring. Remember, there's various forms of data that you need to capture. So a multimodal data model unifying the different data. So it could have your regular financial, non-financial data plus alternative data. For example, a mobile phone, where's your location? For example, I'm based in Singapore, I'm applying a loan in Singapore, but then if this mobile phone geolocation is suddenly in some dodgy country somewhere else, and say I apply this loan at 2 a.m. in the night, so your risk profiling should be more careful, right? So that combination about handling the multimodal data and also that unification with vector data to perform AI and GenAI is very important. And not just that, we have a whole ecosystem to help you to deal with the various development of AI application, including dealing with hallucination. For example, on this left side about the GenAI safety, we have partners that assess the risk of your output from GenAI. For example, the amount of hallucination, the rating of the hallucination that happens, and so on. So work with us, not just thinking us of just a data platform, but also that whole ecosystem to help you build the AI and GenAI application. I'll hand over to Ashwin now.
Yeah. Audible, guys. Thank you, Vayu, for basically introducing the problem and so setting the note as to what you can expect out of the demo. So firstly, to basically understand why we came up with this, or like how did this idea come to the existence, right? So when I was making an application for a credit card that offers something like a no forex markup charges on the credit card, because I'm traveling a lot for these events and everything, and I like a card which basically does not charge me extra on these forex charges. But I was outright denied for such a card. But whereas I hold other cards and which are lot on rewards ratio and everything, but at the same time I was left clueless as to why this card was rejected. So that's when I understood that when basically a lot of these financial institutions make a decision on your profile, credit scoring is a necessary condition but not the only condition that's basically deciding whether you can avail a specific credit product or not. So further to this, let me introduce you, my friends who have volunteered for basically appearing in this demo and giving you an idea on how things are. So let me introduce you to my friends Mark and Rejik. So both have a similar kind of a profile, but I would say, wherein Mark is a musician, he's running his own YouTube channel where he basically talks about music and how he builds music, whereas Rejik is an entrepreneur running a small industry which basically generates some amount of money, but his payments are balloon payments, so he gets paid at the end of the cycle. But Mark basically gets a very rotating income on a monthly basis. So the differences here with these two profiles is that both are quite good high net worth individuals, but at the same time Mark is more responsible with his money, and he basically tends to make decisions on expenditures very carefully, whereas Rejik basically, since he's running a business, tends to make a lot of the expenditures on a monthly basis and is incurring a lot of these payments on a regular basis, on a high value. So both have dreams. So Mark is trying to build his own studio at home, whereas Rejik is basically trying to keep up with his expenditures that that business is incurring for him. So let us look at their credit scores for now. So these credit scores are not based out of any existing credit scores. These are just credit scores that that Vayu just showed you as an equation earlier on. So these are simulated credit scores, and so looking at these traditional credit scores, we can say that both have a very similar kind of credit profile. But in reality, there is a differences in when they try to apply for these credit products. Let's go through the demo actually, and we'll understand this in further. So let me log in with Mark's profile to start with. And once I log in, I'll just walk you through the application, the various parts of the application and how it is structured. So logging into Mark's application, I can see 4 sections here. On the left-hand side, you can see that Mark's profile details as to what the financial institution is collecting upon him as an information. And in the center here, you can see credit health status and description in layman language to him as to what his credit status is at this point of time and why they came to a conclusion. And at the bottom here, you can see a traditional credit scoring that is basically your regular credit score and how it is computed on the 5 factors that we just discussed earlier as a part of Vu's explanation. And this is finally the credit card options, plethora of card options that he's got. Look at that, he's got all the card options as well as some premium card options available to him. And this is all powered by MongoDB. We'll get into that later on when we actually go through the architecture designs.
Yeah, and also to highlight, in this case, even the good customers, you still recommend, because maybe you'll get another credit product from you. So don't just let them off after you have given them something. Sell them some more, okay? And use GenAI to do that.
Yeah. So let's basically now look at Rejik's profile, and we'll basically understand how he stands in this particular position. Like I said, he's not so careful with his money, so he makes a lot of payments, and so the financial model, the alternative credit scoring model, basically deters him as a poor credit health. And that's concerning because both have a same credit score according to traditional credit scoring techniques, but one is given the choice to avail that credit product that he's applying for, whereas the one is rejected. And understanding these kind of scenarios becomes extremely challenging or hard for individuals. And that's where basically the power of LLM comes into picture, wherein along with the alternative credit scoring ML techniques, you can use large language models to explain it back to the end customers how easy it is to dissect his credit profile, how easy to understand, like how can I improve my credit score, the suggestion, the advice, and how do I basically improve it. So this tool also lets us automate this. So before this doesn't disqualify that Rejik cannot avail any products as well. So he still offered some basic products unlike Mark products. So I just wanted to show you that first. So as you can see, he's offered very limited number of credit products that he can avail at this point of time. And you can also note that the credit description has changed from earlier to now, and this is a more personalized product description that is provided to the end customer. And we'll talk about this later on when we get into the descriptions powering with LLMs and MongoDB. So now, if I basically see where I can actually simulate or correct it, I can observe that the monthly rental for Rejig is quite high. And what if I can cut back on my expenses that is unwanted, and basically I can take some corrective measures? Will my credit score improve? Will I be able to avail these other products? So that's what we are actually going to see with this demo. I'm trying to simulate that Rejig has considerably taken actions on his expenditures and reduced his the monthly rental commitment that he's got, and voila, so he's now credit status is good, and that is also reflected as a part of his user profile, the credit profile that the LLMs is able to generate. But that doesn't change the traditional credit score. He's still got the same traditional credit score. Why is this? There is a clear difference on the number of features what we can apply with alternative credit scoring and ML models, whereas when you basically want to introduce them to your credit scoring techniques, you need to vet a feature entirely and have enough data to do it. So here we can see that now that Rejig has got a lot more options, like earlier what Mark had, and similar kind of premium products are made available for Rejig as well to avail and to help with his business, at the same time earn some reward points and have a very comfortable cashback rewards.
Get his wedding done.
Yeah. So let's actually now understand how we've structured this. So all that you saw as a demo right now is available through GitHub for you to consume, experiment yourself as well. So I'll just walk you through the architecture diagrams as a part of this. So as you can see here, so this is a very traditional or a common practice that is used by a lot of these financial industries, where they would be building a single view of data by collating data across multiple sources like credit bureaus, bank accounts, money laundering statuses of various sources that he's making purchases, and other sources where they can tap into information. Once you have the single view of data, you can basically build out a very sophisticated ML model for this data to basically do risk profiling eventually, and also even product suggestions for sometimes. So this ML model that we build basically can explain you the features, as to tell you what features are more important while making the decision for the credit score profile versus the regular traditional credit score. And we'll understand how basically we are leveraging this particular feature of ML models to explain it in layman language. So the ML model that we built out as a part of this demo basically uses these set of features, and the indicators that you see here are the importances that it gives to the various sets of features that it thinks are important to make that credit health status prediction that it was making. So you can see that monthly rental commitment, which is basically comprising of all the alternative payments that somebody is making, as also a very crucial important factor while making this estimation of the credit score, which is not generally considered with your traditional credit scoring techniques. So this is a side-by-side comparison as to how basically LLM is able to understand the model's predictions and the features that it thought were important, and was able to generate this personalized description. You can clearly see that what is the approved credit limit versus how it came to that conclusion, all being described back to the end user in layman language. And this is really helpful as an end customer if I had something like this as a guiding factor to improve and avail specific type of credit products and so on. So getting into the implementation aspects of it, so from the web UI application, we saw that the single view or the feature set of the end customer was available to me. And when I use these set of features against an ML model, I get a prediction. The prediction just says it's poor, it's normal, it's excellent, it's good. So now this is not sufficient, right? This does not give me a good end-to-end user experience. Now, along with this prediction, if I can basically use some customized prompting techniques wherein I can include what the model thinks are important as set of features to make this prediction, and the decision made by the model, and along with that the user profile as actual numbers, if we provide all this information, the LLM with its reasoning capabilities is able to generate the layman description of user profile, which the end user can understand and basically take those corrective actions that we just saw as a part of the demo. So now once we have this user profile, so basically MongoDB basically, along with its vector search capabilities, we are now able to make recommendations of the relevant products to the end customer. And how do we achieve this? The power of vector search basically helps us determine what types of cards are suitable for what type of user profiles. Now, once we have the user profile already that we saw in the application, we can use the power of LLMs to generate various types or nature of cards that an individual can avail. Now, these various card suggestions that the LLM can reason and build as product suggestions, which is generic at this point of time. This is not on any specific financial product or anything. So once this is available, you can use that as a vector search query to perform semantic similarity, and then basically identify various credit card products. Now, once you have identified those credit card products, which is more specific to a private, like this financial institution only offers an X set of products, only those X set of products are retrieved as a recommendation as of now. That can be retrieved back to the, sent back to the end user along with some, customized messaging as to tell him that, this is the card that will best fit your user profile, and these are the reasons why we think that this best fits your profile. And you can entice the customer to have a better conversion on these kind of credit products. Now, we can argue that LLM alone can support all these applications, or fine tuning is the way to go, but that's not always the case. Hallucinations, as you pointed out earlier, is also a main concern, that you can't just go with an LLM to do all these activities. And basically over time, the rules as to how these cards are, the credit products are handed out, or basically how we basically make these credit decisions or type of credit products introduced, keeps changing over time. And for that, basically, we need some form of a RAG system wherein you can basically take these private knowledge bases, which we can then basically break it down into chunks and use LLMs to summarize, to capture only the salient features of the product, or basically how we are basically making decisions on various products, or the cutoffs, or the age probably, or the joining fees and the reward ratios and so on. All the nuances, like only teachers can avail the specific teacher, or those kind of categorizations or summarizations can be done and stored in MongoDB with the description of the card, along with the embeddings of these particular cards, which will be used for retrieval of during the vector search. So
and also we have the dynamic information, like the customer preference. If I like to, I'm a food gourmet, you maybe want to recommend a card with dining discount rather than the standard recommendation. So there are dynamic information from the customer that you won't maybe use it. I mean, you may use it to train or fine tune your model, but of course the preference of the customer could change over time and maybe from day to day.
Yeah, based on your interests and preferences, you can also basically identify the right products for you. So thank you for adding those points. So now actually I'll hand it off to you to give us the key takeaways from the session and conclude. Thank you.
Right, thank you, Ashwin. I hope the demo is interesting for you. I hope the moment that he changed the profile and seeing a new health condition with a dynamic explanation give you some inspiration, all right? So what have we covered today? So first we covered what are the challenges of the traditional credit scoring, okay? I hope you can remember some of the model issue, some of the issues that when applied in the context of credit application. Do you remember them? If you don't, it's okay, can come to us. I think we can make the content available to you as well. Second, how alternative credit scoring can help. What are the key elements of alternative credit scoring? Do you remember that, right? And last but not least, if you like to learn more about this, the code, the article that describe the theoretical background are all on our website. And sorry, the code we're going to publish soon, but we have a first part of this credit scoring series that are published. The second part is going to come with the code from Ashwin, right? So that you can find on our website. So remember the link. If you cannot remember the link, we give you the QR code. So on the left is about this credit scoring with generative AI. The center one is the general financial services hub on MongoDB website. So it talks a lot about different financial use cases, be it credit scoring, ESG, fraud, and so on. And on the right side is about lending, credit, but with the context of how to do green lending, and why green lending would need maybe even more data, and the complexity in processing the green data, and why MongoDB is great for that. Okay, so I leave you with these three resources. And maybe we can now do the Q&A. Okay, so maybe I'll just go back to this slide in case someone needs. So I think we have about 5 minutes. Maybe if you have questions, yes. Can we have the mic for the gentleman here?
Hi. How much real time is this? How long will it take?
Once again, we can't hear from him because of the mic, or
Hello, hello, testing.
oh, we need this, right?
Is this going through? Hello? Okay.
We need.
Yeah. How much real time is it? How long does it take to generate all these
Sorry,
results?
could you repeat that? I'm sorry.
How much real time is it being generated? So how long does it take to generate the LLMs and get me the results in the UI?
So
Is it a nightly job or is it instantaneous?
Yeah, the LLMs are foundational models at this point of time. We are using the foundational models, and these foundational models, we are not even using big models. We are using smaller models to basically generate all these descriptions. So fine tuning can achieve better results at that point. The time delay, basically the entire application process, right, which should be under 1 minute for the entire process to happen. So it's more real time in nature. So generally when you make an application, so the expectation is in a few seconds. It's not like immediately you see that. But for the demo, we have cut short some amount of times, but the entire process here happens within about 5 seconds. The entire.
Great. We have time for.
Yeah, let me ask a
Yeah,
further question.
yeah.
So the banks doesn't provide the information in real time, right? So I go out today, I get a credit or I apply some loan. It takes some time to reflect or send the data to you. So that's where the real time of data. was
So that's why you need the alternative. You need the alternative data, because for example, your mobile information, like just now I mentioned, this is a real case. A study is conducted by the Global Association of Risk Professionals. So they are professionals assessing risk. So they did a survey for across a pool of financial institutions, looking at a loan applied at 2 p.m. and 2 a.m. Which do you think has a higher default risk? In the survey in US,
He says 2 a.m.
2 a.m. You are smart, indeed. So, but this is like alternative data, and you can collect in real time. So, of course, there is indeed the more semi-static data that they'll collect from the provider, but it's not as static as maybe some of the traditional data. They could collect your shopping behavior by real-time API call to a certain agreed aggregator like Amazon or certain. I'm not saying Amazon provide that, but there are some other names that they can actually return in real time. So that API call mechanism infrastructure is very important. So they collect a lot more real-time information from the partners and also from your mobile actually. Yeah.
Okay. Great. Well, I think that's all that we have time for. So
Okay.
let's give it up for Wei Yu and Ashwin one
Thank
more
you.
time.
If you have more questions, we can discuss
We are
off stage.
around, so.
Thank you.